Hello everyone, welcome to Just Invest Today, and today I have a good video for you guys. Today we're going to be talking about 100 to 1 in the stock market by Thomas Phelps. Today we're going to go through 15 points, point form points that are actually in the book, guys. If you haven't read the book, you have to read it. This book is amazing. It'll teach you so much about investing, so much about the mindset that you need to have to become successful in this investment journey. So we're going to talk about how to find these companies. We're going to talk about these 15 points of how to find them and what to look for in these companies. So I'm going to go one by one with these points, and then let's see if I can break it down, get some more knowledge of what I'm thinking and how I think about these investments, how I think about these stocks. And then on the next video, I'm going to make a part 2 of this. There's a lot of points. There's 95 points in this. I'm only going to go through 15, make it short and quick. So the first point: those of us who ask little of life get little. Those who ask much get much, but those who ask for too much get nothing. And this is a very extremely good point. You have to think kind of outside the box. When we're looking at these companies, we want these companies that are asking a lot from themselves. So do they have these big audacious, do they have big goals? Like, do these companies have these very high goals of themselves, and you can see them becoming very big in the future? Because when these companies are asking for a lot, you're gonna get a lot. Like, look what Facebook just said. They're trying to make a metaverse. Like, those are some big crazy goals, and that's what you want. Companies that ask for much are gonna get much, but if it's too much to chew for, then it can turn out bad. But we at least want these companies to have some big goals, so you can actually see 5-10 years from now, like, you can see the success of this company growing into the future. So that's how I think about point number 1. There's more I think about it, but that's a quick and easy route. 2, if you don't buy what has to be sold, you never really need to sell anything. Wow, this is a strong point right here, because if you're buying truly valuable companies, guys, you never have to sell it. These companies are going to compound your money 20% per year, again and again. And these are these very, very strong companies. Like, I own Facebook. Again, I never have to sell Facebook. Like, you never really have to sell Facebook unless something crazy happens in the company, something changes in the metrics. But this company is going to keep growing and growing and growing. Guys, they're doing so much in the VR. They're getting into the e-commerce space. I see them advertising dating now. Like, they're doing a lot. Like, they're doing a lot of stuff right now. And even like with WhatsApp, and they're gonna be like introducing payment system in the e-commerce in WhatsApp. Like, there's a lot of stuff happening with WhatsApp, with Facebook, and you just see what's brewing over there. So this is a very strong point. If you are buying a company that needs to be sold in like 2 years or a year, like, what are you really doing? But on the flip side, if you're buying into a company that needs to be sold in 1 or 2 years, at least you know that. Because I have 2 strategies. One of my strategies is buying these companies, holding for 5 to 10 years, and I'm not even going to touch it. I'm not even going to look at it, whatever. Then I have other companies. They're almost like you're buying them like at a discounted price, and you're just gonna double the amount. You're not companies that have like really, really strong future plans. They're just here. You just buy them so they can double back to their price, and you sell them off. So I have 2 kind of piles of stocks that I buy, right? So that's how I see the point number 2. Number 3, the top 4 criteria: it must be small. When the company is small, it has room to grow. It must be relatively unknown. Popular growth stocks are very likely to perform, but one has to pay for expected growth too much in advance. Guys, you see this with all these stocks right now. AMD, you see this with just like what Tesla, like all the money, everything's already priced into the company. Everyone's expecting these companies to grow. So how much more are these companies going to be able to grow? Because the expected growth in these companies are like almost already there. So you're going to buy companies that are honestly like out of favor, that they're going to have low PEs, they're out of favor, people hate them right now. Like, that's what we're going to have to buy if you want to see strong returns. If you just want average returns, market returns, then just buy what everyone else is buying. Buy the companies that everyone expects to grow high already. It must be a unique product that does an essential job better, cheaper, or faster than before, or provide a new service with great long continued sales increases. And this is just to go to the fact that sometimes the product's got to be unique. It doesn't have to, but when you're doing an essential job and unique product comes to the market, man, there's a lot of opportunity for growth. There's a lot of opportunity for this company to succeed. 4, it must have a strong, progressive, research-minded manager. And with a research-minded management comes innovation. And innovation is key in this market. If your company is not innovating, man, it's over. Like, you have to innovate in this market. Like, things are changing so quickly. 1, 2, 3 years and months. Like, you have to keep keeping up with the times. So if your company is just a mundane kind of basic company, if it has that lasting power, it can last. But man, if you're investing in these technology companies that keep changing, keep like moving, man, just be aware, know what your company is, and just do the work, man. So number 4, look for stocks that professional managers like but are not sure of. So this is going to provide opportunity again. When people are not sure of a company or have a lot of uncertainty, the company is gonna reflect that in the market. They can have high upside, but people don't really recognize it, or people are not certain what's going on with the micro or macro effects of what's happening in the economy, and they're not unsure of it. So the prices are gonna be dropped below, and that's what we're looking for, these cheap companies to buy. 5, unless a company that is operating in a foreign country is conducting itself so that people of that country are better off net after the company has realized its profits than they would be if they had nationalized it, ran it themselves. Companies living on borrowed time. So that states itself. I'm just gonna leave that one. Stay with your most successful stock investments as long as they are increasing their earnings. And that's a huge one. It's hard to do because we like to, once we have this amount, guys, because usually when we buy companies, we have a set value in our mind. We see that, okay, we bought it at 10, and then we put a valuation on 20, right? So when the company that we bought gets to 20, we usually just sell it because we think it's just done for. But guys, if the company is still generating earnings, if there's still room to grow, why sell the company, man? Like, it doesn't make sense. Like, you only have to sell the company if something changes in the company that you don't like, or like management is doing bad things with the company, like just stuff like that, or you just want to buy a company cheaper, so you got to sell that company because you don't have enough money on the side. So you shouldn't be really selling a lot of companies if the company is chugging along. The brand is getting bigger, the earnings is getting bigger, they're generating more revenue. Like, why sell just because it hits 20? Doesn't mean you just automatically sell the company. Like, try to see beyond that, right? So that's what we want. So number 7, try to be associated with people whose self-interests are almost parallel to yours. Therefore, it is probably more important to see who's talking rather than what is he talking. And this is really essential sometimes. I have to get more into this. A lot of companies that I have bought haven't been this way, but I'm getting more into it. Companies with a lot of inside ownership. This is what it's basically saying. Your values align with the management's values, because when you're buying companies with a lot of insider ownership, that means they have to perform. They're gonna make sure the performing of the company, and then when you perform with the company, the stock price is gonna go up with it. And they have a lot of ownership in that stock price too. So they are making sure that the company is gonna progress. They are not gonna make these boneheaded decisions and all these other things because they don't really care about the company, because their net worth is with the company they have or they're owning. So this is a good thing to keep in mind. You want at least 10 to 15%, but I've invested in companies without that and I still done really good. So it's a double-edged sword. Like, just make sure management, and you understand what management's saying, listen to what they're saying, listen to their earning calls, because I think that's the most important. Like, reading what they're saying in the earning calls and how they're envisioning the company, I think is very important. 8, to make money in stocks, you need to have the vision to see them, the courage to buy them, the patience to hold them, and patience is the rarest of them, of the 3. And this is a crazy. This is crazy. This is what I'm talking about right here. You have to have the vision to see these companies, and a lot of people don't have that vision of just trying to see. You gotta almost imagine where this company can be in 10 years. That's very important in investing in stocks, especially when you're trying to invest in a very strong company. If you can't envision that company 10 years to be still holding its ground, still being strong in the field, don't even invest in the company. And then when you see that price, that bargain price that you love, the value is under the stock price, yo, you gotta have the courage and your conviction in buying those companies and not fooling around. When you see it, just buy it. Like, don't think, second guess it. Like, think, as long as you've done the research and you understand the company and you know what it is, just buy it. And then you have the patience to hold them. Because the patience is the most important thing. Because, guys, when we're buying these companies, they're very underpriced. The market doesn't like them. People hate them. Just look at what's happening right now with Alibaba. The market hates Alibaba. We bought it at a good price. We understand the value. The value is already 300 plus. Everyone knows that, but that doesn't matter. Is what are you gonna do? You're gonna have to be patient. You might have to hold out 2 to 3 years, but we know at the end of the road, this company is very strong. The business fundamentals is there. We don't care about the noise. We stick strong and we stay patient. So that's huge. Number 9, far more money can be made by good stock selection than by good market timing. And this is a very key thing. And this is, I have to ingrain this one into me too, because I always think that market timing is the best thing. Like, look what's happening in the market now. I changed my mind on this because look what's happening in the market now. There's so many expensive things going on, and every stock is expensive and blah blah blah, right? But still, we cannot time the market. We don't know when this crash is gonna happen. So even in this market, if you find a company you like and you have cash on the side, just invest in it. Don't worry about, oh, the market might crash in 4 months, because you don't know. And then that might stop you from buying this company even though it's cheap in this market, because you still think there's a crash coming in the back of your mind. So you're holding out, but you don't know when that's gonna come. So what's the point of holding out? Buy the company. It doesn't matter what time it is, what time of day, how expensive the market is, what's happening. Warren Buffett said in a lot of his shareholder letters, he's buying See's Candy. It didn't matter. He bought See's Candy. He bought Washington Post. He bought Geico. He bought all these companies at different times. It didn't matter what the market was doing. He didn't focus on the market. He focused what the value of the company was, and then he bought it. So that's what we want to do. If you can't find anything of value, okay, it's okay to have all that money on the side, waiting until you find an opportunity. But when you find an opportunity, don't wait for it because you think the market's gonna crash in a year or 3-4 months, because you don't know. Just get into that company if it's something of value. Number 10. Many stocks could have been bought at 52-week highs for many years and still turn out 100 to 1 winners. All one has to do is identify them and stick to them. And guys, this is a big one for me. I used to do this in the past. I used to think that since the stock ran up, it's at its 52-week highs, why would I buy this? Because the stock already ran up. And I used to think like this, but guys, that's wrong way to think. It's all about you valuing the company and coming to your conclusion and then looking at the price. Even if the price ran up, if the value is still way more than the price, it's still a good investment, even if it's at its 52-week high. So you can't look at the 52-week highs and think it's a bad investment because it's ran up, guys. It's all about buying the right companies and investing in them, not worrying about trying to time the market because it's at its 52-week highs, and then now you're gonna wait for this. You're gonna try to wait for this huge dip or huge downfall. But what if that never happens? So you just missed out on maybe 2-3 years of returns because you wanted this. You were afraid because it has 52-week highs, even though you thought the company was undervalued. And this goes back to what Warren Buffett has said many times. In his Coca-Cola investment, it was like around 1988 or around there. Guys, people were saying Coca-Cola was already at its peak. It had such a dominant market share. It was it couldn't get any bigger. Like, people were saying that to Warren Buffett when he bought into it, but at the time he knew Coca-Cola had a huge runway for growth, even though it was huge already. It was the number one company, and people still thought it really ran up way too high. But it wasn't bought at the 52-week highs, but still, people just thought the company was already it was already at its value. But no, Warren Buffett saw this company as being very valuable still, and it was gonna go for 10, 15, 20 years, whatever. So just making sure you buy these companies when you know the value is there, and the price is undervalued in the market. Just buy the company. Don't worry about market timing, and don't worry about the 52-week highs. So wow, so that was a lot, guys. So I think this video is gonna get too long anyway. So next I'm gonna continue on. I know it's supposed to be 15, but that's a good strong 10 right there, guys. Please like this video, man. Like it, subscribe to my channel. The next video, I'm going to do another run of this. I'm going to put this article down below if you want to look at it. The strong 95 points of 100 to 1 in the market. It's a good article to read. In the next video, I'm just going to go back with it, generate more ideas, more commentary on these points. So guys, like the video, subscribe to my channel, and I'll get back to you in the next video. Peace!